So in chapter 5, we're going to learn how to use pro forma models to forecast the free cash flow of a company and then use that forecast to calculate the value of the company. So before we get into pro forma models, let's use a simple example to review some basic accounting concepts regarding the major financial statements of a firm. Okay, as we know, a firm has three major types of financial statements. Right? We have income statement, we have balance sheet, and we have consolidated statements of cash flow, right? Or cash flow statement. So first, let's take a look at an example. So in our example, you are starting a company which is a food truck company, right? And to get your company started, you finance through both debt and equity. So you borrow $100,000 in debt and then issue $100,000 of stocks. So at year 0, after you raise this money, you're going to spend $180,000 on fixed assets, such as truck, kitchen equipment, and so forth. And you're going to assume that the depreciation rate is 20% per year, meaning the fixed asset is going to depreciate over the next 5 years. So on average, the dollar amount is $36,000 per year. So after spending this money on truck and equipment, you still have $20,000 left. So that's going to be your cash. So let's see, what does the balance sheet look like at the beginning, which is year 0 here. So you raise $100,000 in debt, $100,000 in equity, and we're going to assume that at the beginning you don't have any current liability and you haven't accumulated any earnings yet. So this is going to be the right hand side of your balance sheet. So the total would be the sum of the 4. Okay. And on the left hand side of your balance sheet, you would have cash, which we assume is $20,000. And the current asset, let's assume, because your company is not running yet, so at the beginning the current asset is equal to 0. Fixed asset, this is your equipment, your truck. So at cost means you have spent $180,000 on those assets. No depreciation yet. Okay, the depreciation will start in year 1. So right now everything's new. So the net fixed asset is equal to the gross fixed assets. So the sum of the left hand side is equal to B26 plus B27 plus B31. So you can check the left hand side must be equal to the right hand side. So this is equal to this. Okay. In year 1, your company is up and running. Okay, so you would generate your first annual sales. So in year 1, let's assume that your annual sales is $120,000 and your cost of goods sold is $60,000. Okay, so you're going to pay interest on your debt and you're going to earn some interest on your cash balance. Okay. And by the end of the year, we also assume that you have invested $15,000 in current assets. Right? So let's say this is your inventory. Okay. And you have also accumulated $10,000 in current liability. So these are account payable. So think of this as your credit card bill, okay, or your credit card balance. Okay, you also have invested $50,000 in maintaining and improving your equipment. So this is like the money you spend on maintaining your truck or buying new kitchen equipment and so forth. Okay, that's the year 1 capex basically. So given these numbers, let's fill up your income statement in year 1. So sales is 120. Cost of goods sold is 60,000. Remember, this is cost, so it's going to be negative. And interest on debt, so we're going to say it's equal to, so we're assuming that interest paid on that is 8%. So again, this is a cost, so it's negative 8%. Let's fix that. So we can do the average, just kind of conventional. We're going to do the average of the current debt level and the previous year's debt level. Okay, so this is going to be the interest paid on debt. And the interest earned on cash is going to be equal to the interest rate on cash. Fix that. Again, we're going to use this convention, the average of the current cash level and the previous year's cash level. So that's not a percent. Let's convert that to a number. Okay. Depreciation, we're assuming that the depreciation is negative $36,000 each year. So profit before tax, we have that. Tax is equal to the tax rate, which we assume is 40%, times the profit before tax. Okay. So negative. It's a negative number because it's a cost. Profit after tax is equal to C19 plus C19 and C20. Dividend, we're assuming that dividend payout ratio is 0%, so it's basically 0, but just to be more formal, I'm going to say it's equal to negative the payout ratio B10, fix that, times C21. Okay. Retained earning is equal to sum of C21 and C22. Okay. So this is going to be the retained earning in your first year. Okay. Next, let's see how your first year's operation changes your balance sheet. So we're going to assume that, first of all, the current asset we're assuming is $15,000, right? The current liability is $10,000. So we have current asset is 15,000 and current liability is 10,000. Okay. And the fixed asset at cost, so this is the amount of money that you have spent on fixed assets. So at the beginning you invested 180, so that's in B29. And then you invested another $50,000 in year one, so that's your capex in year one. So we're going to add that to your total spending on fixed assets. So this is your cumulative spending on fixed assets so far. Depreciation, we're assuming, because remember this is the balance sheet, so all the numbers are cumulative numbers. So depreciation is the total depreciation up to this year, right? So in theory, it should be equal to your previous year's depreciation plus the new depreciation in this year, which is here, right? And of course, because this is your first year of operation, so the sum is going to be equal to your year one number, but in general, it doesn't have to be. Okay, net fixed asset is equal to fixed asset at cost minus depreciation. So here, because our depreciation is already a negative number, so I'm just going to add that. So this is going to be your net fixed assets. So we're assuming that you haven't gone out and issued more debt, so the debt level remains the same. The equity level remains the same. Cumulative earning is equal to your original number B37 plus the new retained earning. So your total value, the total value of your company should be equal to this number. Okay, again, we balance out the balance sheet. That's equal to 38. Finally, we can back out the cash level, which is equal to C32 minus C31 minus C27. Sorry, something's wrong. Minus C27. Okay, so this is going to be your new cash level. Okay, so this is going to be your year one income statement and the year one balance sheet. So next, let's take a look at your cash flow. So according to your balance sheet, you can see that your cash balance has reduced from year 0 to year 1, right? So the change is equal to C26 minus B26. So it's been reduced by $9,220. So to make sense out of this number, let's track each component of your cash flow. Okay, this is sort of a back of envelope calculation, which kind of intuitively go in here and figure out each component of cash flow. Okay. Next, I'm going to do this more formally by filing the cash flow statement. Okay. So what's going to be the cash flow of your company? It's going to be equal to your sales. Okay. At the beginning, we're going to assume that these are all cash. Okay. And then we're going to make some small adjustments. Okay. So sales is a cash inflow, so you make money, and then you have to pay for cost of goods sold. So let's see, 15, and then you have to pay your interest. Then you earn interest, and then depreciation is not cash, so we skip that. And also, you have to pay tax. And you also need to pay dividend in general. Here is 0. Okay. Also, in year 1, you spend $50,000 on your capex, so you have to pay for that. Minus B11. Okay. So another component here is the increase in your current assets. Okay, you should think of this as the increase in your inventory. And so these are the goods you haven't sold yet, but you still have to spend money to create them, right? So that's a cash drain. I'm gonna minus C27 minus B27. Okay. So it's like you spent $15,000 in this year to make some food that you haven't sold yet. Okay, obviously this is gonna cost you. So another component is the change in current liability. Again, think of current liability as the balance of your credit card. So here, let's say you spend $60,000 on cost of goods sold, but in the first step, we're assuming that this $60,000 is all cash, so this is a cash drain. But it's possible that you have spent some of this money using your credit card, and you haven't paid your credit card yet. So here, basically what it tells you is that you have spent $10,000 using your credit card, and you haven't paid it yet. So the actual cash drain in the current year should only be $50,000, right? You need to add this $10,000 back to the cost. So we're going to add this back. So that's C34 minus B34. So we care about the increase in current liability. That's the sort of your credit card balance in the current year. Okay, that's it. See, after you accounted for all the components of your cash flow, then you should get exactly the same result as the number you got by looking at your balance sheet. Okay, so now let's do this more formally by preparing your cash flow statement in year 1. First item, profit after tax. It's right here. Add back depreciation, so it's equal to negative depreciation. So remember here, whenever we say add back, I always use a positive number. Whenever we see subtract, I'm always going to put a negative sign. Okay. So here I'm going to say negative change in current asset, that'll be equal to C27 minus B27. Add back change in liability, so that's equal to C34 minus B34. So the sum of the first section, we have this number. The second section is the investment in, is the cash flow from investing activities. Okay, the first item is your capex, which is a negative number. So year one capex is 50,000. We didn't trade securities, so that's 0. The final section is your investing. So here we don't really make any new investment. The final section is your financing activity. Here we didn't use any new financing instruments. So, and also we didn't pay dividend. So everything is 0. So finally, the total cash flow of the company should be equal to the sum of this. And if I format that to keep more decimal places, as you can see, the 3 approaches should provide the same answer. So that's how you make sense out of the cash situation of the firm. Okay, that was a quick review of accounting concepts. So now let's look at our first pro forma model. Okay, some people ask me what does pro forma mean. I guess pro forma basically means expectation or forecast, right? So a pro forma statement that we're going to generate represents our forecast about the future, which may or may not turn out to be true, right? So if you're an accountant and you're filing a statement with the SEC, you have to tell the SEC, is this your forecast or is that something that has already happened, right? So like the 10K or 10Q we have downloaded, those are not pro forma because those have already happened. So those are real actual numbers. But the statement we're generating are forecasts, so they're called pro forma. Okay, that's why we're calling them pro forma statements. Okay, so in a typical pro forma model, we're going to identify a driver, which in this case, we're going to assume that the driver of this model is going to be the sales of the company. Right? So the sales is going to grow, and everything else is going to be tied to the sales. And we're assuming that the sales growth rate is going to be 10% per year. Right? So let's generate our... So year 0 typically is our current year, so this has already happened. So this column is not pro forma, right? This is the actual numbers. So pro forma starts from year 1. So this is the year 1 in the future, year 2 in the future, and so forth. Okay. So our year 1 sales forecast is going to be equal to the current sales multiplied by 1 plus the sales growth rate, 2. And like you can see, we are going to tie everything else to the sales number. First of all, we're assuming that the cost is going to be 50% of the sales. So that's going to be equal to B6 times C15. So the interest payment on debt is going to be equal to the interest, which is a negative number, the interest rate on debt multiplied by the average debt level of the current year and the previous year. Interest earned on cash is equal to the interest rate on saving times the average cash level. Depreciation. Here, our assumption is that the depreciation rate is going to be 10%, meaning that's going to be the 10% on the fixed assets at cost. Okay, the gross fixed asset. So we're going to do something that's similar we did with the debt and the cash earning. So the depreciation in year 1 is going to be equal to the rate B7 multiplied by the average asset at cost in the current year and in the previous year. Okay. Of course, this is going to be a cost, so it's going to be a negative number. Profit before tax, and tax rate is 40% multiplied by C20. Profit after tax equal to sum of dividend is equal to negative, which is the dividend payout ratio, applied to the number above it, retained earning. Okay, now let's look at our balance sheet. So current asset is assumed to be equal to 15% of sales. Of fixed asset at cost is going to be equal to, basically, if you look at the year zero number, the gross fixed asset, the top line, should be equal to this number here plus this number here, right? So, but this number is already, because it's depreciation, so it's entered as a negative number. So the formula, if I just want to add up the two numbers, actually what I need is C22 minus C32 minus C31. And the depreciation, again, this is a cap balance sheet, so this is going to be accumulated depreciation. So that's going to be equal to B31, the previous accumulated depreciation plus the new depreciation. Okay. The net fixed asset. So here we're requiring that to support your growth, you need to maintain 77% of your sales in net fixed assets. So that's 77% B5 multiplied by sales. So here we're going to assume that the current liability is 8% of the sales, and we're assuming that we're only using internal financing, meaning we're not issuing new debt or equity. So debt and equity stays the same as before. Accumulated earning is equal to the previous accumulated earning plus the new retained earning. Balance sheet has to balance out, and the final step, we can back out the cash level. Now we have our forecasted income statement over the next 5 years. Okay, so these are pro forma income statement because they haven't happened yet, right? So we're not sure whether they're going to happen or not. So they're just a forecast. Okay, now let's prepare our free cash flow, free cash flow calculation. Okay. Profit after tax, depreciation, subtract increase in asset, in current asset, add increase in current liability, subtract the increase in fixed assets at cost. So this increase in fixed asset at cost, that's basically your capex in year one. Okay, the difference between these two numbers is your capex in year one. So we're subtracting your capex. Interest on debt would be this number here. Again, we won't add it back, so, and this is a cost, so I'm gonna turn that into a positive number. And also we're going to do this on an after-tax basis, so we're going to do 1 minus tax rate. Fix that. And subtract after-tax interest on cash equal to negative. So now we have our free cash flow forecast over the next 5 years. So we can use this forecast to value the company. So let me copy this down to row 55. Go to let's see, 50. So to make this forecast, because obviously the company is not going to disappear after 5 years, so we still have to make some forecast about what's going to happen after 5 years, right? So as usual, we're going to do this two-stage format. So this is our first stage over the next 5 years, and then in the second stage is from year 6 forward. So the growth rate beyond the fifth year is the long-term growth rate in free cash flow, right? So we're going to make some assumption there. Let's assume that it's going to be 5%. And also we need to calculate the WACC for this company. So without actually doing the calculation, let's just say the number is 20%. You can play with other numbers here if you like. So in year 6, the forecasted free cash flow should be equal to G55 times 1 plus remember from this year on, beyond year 5, it's going to be a long-term growth rate. So it's going to be in B51. Okay. So that's going to be your year 6 cash flow. Right? So the present value of this cash flow plus this cash flow plus this cash flow and plus all the future cash flows is given by the Gordon model for the infinite growing annuity, which is equal to the first cash flow, which is this one, in age 56, age 55, okay, divided by discount rate B52 minus B51. So this represents the present value of all these cash flows going forward, discounted back to year 5. Okay, so that's the present value of everything here. Of course, since you have this, you don't have to worry about these cash flows afterwards. Okay. So you can do it this way, but I would say probably after you understand this, I would probably prefer doing this in a more concise way, in a sense I don't want to write this out. Okay, so I know this number is simply this number times 1 plus the long-term growth rate. Okay, so instead of referring to this number here, I'm just going to refer to this number here and then multiply that by the long-term growth rate. So let's give you the same result. Okay, but in this case, I don't have to write this out anymore. So we're going to use the mid-year discounting convention. If you don't remember that, you can review the lecture notes for the lecture videos for chapter 4. Okay. Basically, we're assuming that all cash flows occur in the middle of the year as opposed to the end of the year. So this is the enterprise value of the company. So this value comes from the company's ability to generate future cash flows. Right? So to calculate the total value of the company, we also need to account for the current cash holding of the company, which is in B27. You add up the value of its future cash and the value of its current cash. You have the value of the company. And now I'm interested in calculating the stock value of the company or equity value of the company. So I need to subtract the value of its debt. So the value of debt, we're just going to use the book value, which is in the balance sheet. Because typically for debt, hopefully the market value and the book value of debt are kind of similar. But for equity, they're going to be typically very different. You can see, as you can see from this case. So the market value, according to my analysis of this company's stock, should be equal to its total value minus the debt value. So that's going to be my estimated equity value of the company, right? As you can see, this equity value is very different from the book value of equity, which is here. So the book value of equity is basically its sort of its liquidation value. In other words, if you're gonna stop running this company, just sell everything, close the door, sell all the equipment you have, and pay back your creditors, then what's left should belong to the equity holder. So this is kind of that value here, right? But of course, when we value a stock, we're not going to assume that we're going to close down this company right now, right? So we're assuming that this company is going to be running in the future. So it's going to be generating more money in the future. And this equity value is based on this company's ability to generate more cash going forward. So that's a forward-looking measure. This is how we value a company, and the price is stock, right? And the book value of stock is a backward-looking. That's basically how much money you have put into this company, right? So that's not really relevant for our valuation. Okay, so the next we can do is to do some sensitivity analysis. For example, here I'm assuming that the sales growth rate is 10% per year, right? So my forecast is based on that. So what if I change my sales growth rate forecast? Right? What's going to happen to my stock value? So let's use data table to figure that out. So I have the sales growth rate, and I have my, let's say I have my equity value. Okay. So I want to check a few assumptions about sales growth rate. So let's say I go from 0% and 2% all the way to 16% per year. So equity value is in B63. Okay, so this is going to be the equity value corresponding to each forecast of sales growth rate. So if you like, we can insert a picture, I think, to make things more clear. Okay, as you can see, as you grow faster and faster, as the company grows faster and faster, it's not necessarily the case that its equity or its stock value is going to keep going up. Right? Here in this case, actually, as the company grows too fast, probably beyond this point, the shareholders' value is actually going to decrease. So here the reason is that as you grow faster, you also have to maintain a higher level of fixed assets. So you're going to have to keep investing in your assets. So that's capex, right? So that investment is too high, and at some point that's going to hurt the value of the company. So another thing we can try is to do a two-way sensitivity analysis. For example, if I want to figure out how the value of my stock depends on my assumption about both the long-term growth rate and the WACC, then I can do I'm going to put long-term growth rate here, and let's say it could go from 0% increase by 2%. Let's consider a few numbers here, say all the way up to 10%. And my WACC is going to go from, let's say, 6%, 8%. So here the row is for long-term growth rate, and the column, this column here, is for WACC. So this tells me based on different assumptions about long-term growth rate and WACC, what's going to be my estimated stock value, right? So if my long-term growth rate is 2%, my WACC is 10%, then the stock value should be this number here. Right? So again, as usual, we see some number that doesn't make sense here. It's because the condition for the Gordon model is violated. Again, we discussed how to deal with that in chapter 4. So I'm going to use the if statement. Okay. So this will be a two-way sensitivity analysis. So next I want to see a couple of variations to this model. Remember that the nice thing about pro forma model is that it allows you to explicitly make assumptions about various aspects of your operation, about your financing policy and so forth, right? So basically these numbers represent specific assumptions. So let's make some changes to those assumptions. For example, like I said, the reason that you cannot grow too fast according to your forecast is because as you grow faster and faster, as your sales becomes larger and larger, you also have to invest a lot in fixed assets, right? That's because your net fixed asset will keep growing with your sales, right? So what if we make a different assumption? We're going to assume that your net fixed asset is going to be constant. So as you increase your sale, you don't have to increase your net fixed asset. Okay. If we were to make that assumption, let's see what's going to happen. So I'm going to copy the results we already have. Into the next spreadsheet. Okay. And to make that change, I'm going to assume that the net fixed asset does not grow with sales. So it remains constant, meaning the current number is equal to the previous year's number. So it doesn't grow. In this case, let's see. So again, you need to actually update your data table, because this one won't update automatically. So you have to rerun your data table. Okay, these are the updated numbers for the stock price. So now if I insert a figure here, guess I shouldn't. Okay, so if you insert a figure, that tells you the relation between the stock price and the forecasted growth rate. Now you can see that the faster you grow, the more valuable your stock is. Right? So that's because we don't have to maintain a higher net fixed assets. So that's the difference between this one and the previous example. Okay. So another assumption we made in this first example is that we're going to hold our debt and the stock constant, meaning we're not doing any external financing, and all the growth is going to be financed through our own cash. But this is not a problem, because as you can see, as we grow, the cash level actually will also grow. So we have plenty of cash to finance our growth. But what if that's not the case? What if it's not possible for us to finance our own growth, right? So here, let's make some changes to our assumption. Suppose our sales is going to grow at 20%. The current asset to sales ratio is 20%. Net fixed asset to sales ratio is 80%. The equity payout ratio is 50%. Suppose we make these assumptions. Let's see what's going to happen to our company. Let's go back to example 1A. Again, we're going to copy everything down here. Just going to copy up to this point. Okay. So based on these new numbers, as you can see, right now, the cash balance of our company will turn negative in year 2, which is clearly not possible, right? So negative cash doesn't make sense. So which means as we grow our company, we're going to be running out of cash from year 2 going forward, right? So our cash will continue to decline, and we won't have enough money to finance our growth. So to address this problem, then you have to basically use external financing. You either need to issue more debt or you need to issue more stock. Right? So here, let's assume that we're going to just issue enough debt so that our cash balance does not turn negative. So we can barely maintain a cash level is equal to 0. Okay, so at least we need a non-negative cash level. So we don't hold any cash, and to be able to maintain such cash level, we have to go out and issue more debt or stock, right? So let's see, how much debt do we need to issue? Suppose we're going to use debt. So to do that, we're going to recalculate our balance sheet numbers. So So obviously these numbers are not correct anymore. So based on a new assumption, we're going to do D27 plus D28 plus D32, right? So that's going to be the new value of our assets. Oh, sorry. Let me do that again. So it's equal to D27 plus D28 plus D32. And the balance sheet has to balance out. So that's equal to D33. Again, using these numbers, the sum of the current of these numbers won't be equal to the total. That's because we need to change the debt number. So the debt number is going to make the balance sheet work out. That's going to be equal to B39, D39, which is the total, minus D35 minus D37 minus D38. So you need that much debt so that your total asset value can be equal to this number. And copy paste the formula to the other columns here. So this is going to be your new debt level going forward. So consistent with our intuition, now because you're burning too much cash in your operation, so you have to go out and issue debt, which means your debt level will keep going up. Okay, in the final example, we're going to look at a so-called project finance. So this is like in year 0, you don't have any operation yet, so you just build up your project or your company, similar to our food truck example, right? So in our example, you're building up a new company through the financing activities. Or you can think of this as you already have a company, but you're starting a new project, so you're financing your project within the company and forecasting its performance, right? Either way. So we're going to make several assumptions in this problem. First of all, we're going to assume that we have a fixed debt schedule, meaning we're planning on paying back our debt within the next 5 years. So now you have 1,000, here let's say the unit is $1 million, right? You have basically $1 billion in debt. I'm going to pay it back over the next 5 years. So then the next year's debt level should be 800, and the next year's debt level should be 600. So by year 5, you'd be without any debt. Okay. So we're also going to be assuming that we have constant net fixed assets. So that's going to be similar to our example 1b. So this net fixed asset is going to be equal to its previous level. Okay, otherwise it's going to be very similar to what we did before. So let me just fill out this these tables. Here we're going to assume that the company is not issuing more stock, so the stock level will stay constant. Okay, so if you want to do some valuation, you can just copy paste this section over. You need to make some adjustment here because this is supposed to be cash, but the cash is actually in B26 in the current spreadsheet. So it's really the initial cash should be in B26, and the current debt should be in B35. So now it should be correct.